Many Canadians are searching for steady, reliable income, and Harvest's HHIS ETF, well, it's promising exactly that. But how does it work? And, well, is it too good to be true? Fasten your seatbelts, folks. This is going to be a good one. In January 2025, Harvest launched their single company ETF series that focused very heavily, yet not exclusively, on the technology sector. The general concept was to create high income funds around specific companies like Nvidia, and then generate additional income using covered calls or covered calls with 25% leverage. Many of these ETFs, they did come in both options, a covered call version and a covered call with leverage version. In the case of Nvidia, they have the covered call version, NVDH, and then, well, the covered call with leverage, or they call it the enhanced version, NVHE. With about 15 companies to choose from, Harvest then they did a really smart thing. Like Sauron, they crafted a master ETF, one ETF to rule them all, or more accurately, to provide a diversified income option. They created HHIS, the Harvest Diversified High Income Shares ETF. This ETF was designed to give you exposure to, well, the lot of these single company high income share ETFs. A sub to the channel is your one click to rule all the future content. I want to talk a little bit about what this ETF actually holds. I mentioned that there were two options for these single company ETFs. So once again, we got the covered call and then we got the covered call with leverage. Well, in the case of HHIS, they are holding the covered call with leverage version of these single stock high income ETFs. So as at June 30th, 2025, let's take a look and see what they have in that basket. At the top of the heap, they've got Coinbase, and they're diversified 8.5% into Coinbase. We also have Broadcom with 8.4%, Nvidia 8%, Palantir 7.6%, and good old Netflix coming in with 7.5%. Microsoft also 7.5%. We have Strategy at 7%. Meta's there sitting at 7%. AMD at 6.6%. Amazon coming in at 6.5%. Tesla sitting there at 6.3%. Alphabet sitting at 5.7%. Costco coming in at 5.6%, Eli Lilly at 5.3%, and they just added Apple with a 2.4% stake in that basket. Yes, they do have a very tech-heavy exposure, but you are going to get some exposure as well in this basket to healthcare, consumer staples, and well, even cryptocurrency. Now that we have a general idea what this ETF is about, let's see what we have in terms of fundamentals. If there are numbers involved, we need to call on the high priest of payouts, the sultan of yields, the one and only Mr. Math. As usual, we will start out with a little surface data. So at the time of recording, their current value is coming in at $12.43, and they have an NAV of $12.27. Those net assets under management, $537.62 million. That's actually not too bad for a fund of this nature. Looking at their management fee, now they do list it at 0%. However, this 0%, it's a wee bit of an illusion, as HHIS is subject to the underlying fees of the funds it holds. For example, the management fee of NVHE is 0.4%. Thus, the management fee on that 8% of this fund would have a fee of 0.40%. Oh boy, it sounds like this is going to get confusing. Well, it actually isn't, because all of these funds have a management fee of 0.40%. So effectively, the management fee of HHIS, it works out mathematically to 0.40%. Now you might be saying, but what about the management expense ratio? This is a new fund. We do not yet know what that's going to look like. That'll be a question for next year, I have a feeling. Looking at volume, they do have an average volume, according to Yahoo, of 329,607. So that's actually not that bad. That's a pretty good volume for sure. just to take care of a couple little small details. When it comes to the covered calls, the underlying funds will write on up to 50% of each of these funds. And as well, leverage will be up to 25%. So these are just a couple pieces of data to keep in mind. Okay, that looks fantastic. Let's go take a look at their returns. Let's start with that dividend. They have a yield of 24.39%. Oh, that's pretty good. That is a monthly dividend of 25 cents per share. Now, this ETF, they were launched in January. So when we're talking about the returns, quite honestly, we only have a year to date. So their year to date return on investment, 0.65%. Add in those dividends, total return, 10.77%. The lack of history does make it much more difficult to use the fundamentals in a more predictive way. However, despite that, I do believe I am ready for the final verdict. HHIS is a very interesting ETF, and with covered calls and leverage as a key component of the underlying ETFs, risk is absolutely a core aspect of this ETF for sure. The current dividend of 25 cents per share. Now, that's a good number, but I have to say it is not guaranteed. And in fact, within the disclaimers for this fund, they do have a minimum payout of 16 cents listed. Let me be clear, that does not mean we will see the lower dividend. And I sure do hope we never do. What it does tell us is what could happen in a worst case, as defined by Harvest, scenario. This ETF does have, it has half decent diversification working for it, which will bode well when 1, 2, or even 3 of the underlying funds are struggling. More than 3, and they will definitely feel that for sure. Now, that diversification is really, really strong in the tech sector. So when you look at tech, they're diversified across that sector really well. And as a result, if that tech sector crashes, so too will HHIS's NAV, because they're just so diversified quite heavily into technology. That does not necessarily mean you are going to receive less dividends, as this is a fund that can still produce income in a bear environment. However, in a strong bear market, the loss of the ETF's value can really make that income feel, kind of less good. Overall, this is a very nice fund for income investors, provided you are prepared to ride out tech-specific crashes and not let the loss of NAV get to you. Keep in mind, the leverage on the underlying funds will it's sure going to make it so that you feel it quite a bit when they are falling. At the same time, that leverage will also make recovery a lot more exciting on the way back up too. We're talking 25%. So you'll fall 25% harder, you'll rise 25% higher. Although you do have to keep that loss of upside potential because of the covered calls in mind as well, because that will hamper that growth back up a little bit for sure. For the dividend growth total return investor, this actually still could be a good ETF for you if you are looking for an income play. But by no means should it be a significant part of your portfolio. On the long scale, you are still better off with individual stocks or, of course, those dividend growth ETFs. Now, I do like this ETF. In fact, I am holding it in the 0 to 100K challenge. As well, I do like to have a small bit of income in there. I do use it for my passive rebalancing efforts. If you are interested in HHIS, then don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on more income ETFs. Thank you for watching, and I will see you in the next video.